Hey everyone, welcome back to Corporate Decoder, the place where we break down the nitty-gritty of corporate filings. And let me tell you this latest filing from TIN, CINTEIIINTI. IONATIO Incorporated is quite the ride strap-in. So Tianci International Incorporated has dropped its annual report for the year ending the 31st of July 2025. And folks, it is a mixed bag. We have a company that is clearly trying to grow its logistics business, but facing some serious headwinds and some truly eye-popping expenses. Forget the fancy jargon, let us see what is really going on under that corporate hood. First off, for those keeping score at home, TINCI, your ticker symbol is CIIT, and it is traded on the Nasdaq Capital Market. Now that sounds great, but this filing tells us the trading is pretty thin. What does that mean for you? It means if you want to sell your shares, it might be really hard to find a buyer at the price you want. Think of it like trying to sell a niche collectible on a huge marketplace. It can take time and you might have to drop your price significantly. Alright, let us talk about how this company even got here. It was basically a shell company until March 2023, when it did a share exchange with an outfit called RQS Capital Limited. This is like a reverse acquisition where RQS United Group Limited became the new owner for accounting purposes. This is important because it means the history and the previous financial performance you are seeing are really from RQS United and its subsidiary Roshing International Co-Limited. So what does TINCI actually do through Roshing? They are in the global logistics business. Think booking and arranging transportation for everything from containers to bulk goods. They do not own ships or trucks themselves, instead they charter space from others. Smart if you want to keep costs down, but it also means they are heavily reliant on their suppliers. They are also trying to get into global mineral trade and are accumulating inventory too. On top of that, they dabble in selling electronic parts and offer some consulting services. Not exactly a focused business model, is it? Now let us dive into the numbers because this is where things get really interesting, especially for the year ending the 31st of July 2025. Their total revenues went up about 8% to $9.3 million from $8.6 million the year before. That sounds okay, right? But then you look at the cost of revenues. That jumped a massive 17% from $7.6 million to $8.8 million. So while sales nudged up, costs climbed much faster. This is the big one, folks. Their gross profit margin nose dived from over 12% in 2024 to just 4.85% in 2025. This is a huge drop, and it tells us they are making a lot less money on each dollar of sales. They are saying they are keeping prices stable to build market share, but this margin compression is a serious concern. It is like selling more lemonade but making less profit on each glass because the lemons and sugar cost way more. And then there is this eye-opener: general and administrative expenses exploded. They ballooned by 462% from about $520,000 to nearly $3 million. Why the increase? They are spending big on finding companies to acquire about $500,000. They are also hiring people for public relations related to their Nasdaq listing, costing another $500,000. Plus a one-time bonus of $480,000 to management for their successful public offering. Add in consultant fees, accounting costs, and you see where that money is going. This is a massive increase, and while some of it is for growth initiatives, it is a huge chunk for a company that is struggling to make money on its core business. The bottom line, folks, is a net loss. For the year ended the 31st of July 2025, Tianci reported a net loss of over $2.6 million. This is a huge swing from a small net income of just $54,450 the previous year. They made money on logistics, but the soaring costs and expenses swamped those gains. Now for liquidity, as of the 31st of July 2025, they had about $2.4 million in cash. They got a big chunk of that from their public offering in April 2025, which netted them about $5.4 million after fees. They believe this cash is enough for the next 12 months, but they also say they might need more money for investments or acquisitions. This is classic small company talk, meaning they will likely need to raise more funds down the line, possibly diluting existing shareholders. Financing activities show a big inflow of $5.2 million in 2025, mostly from that public offering. This is crucial because their operating activities used up over $3.2 million in cash. This means without that IPO money, they would have been in a very tight spot. Looking at the balance sheet, we see a significant increase in additional paid-in capital, probably due to that stock offering, but their accumulated deficit also grew to nearly $2.9 million, further highlighting the struggle to become consistently profitable. They have got Series B preferred stock outstanding, which could be converted into common stock. This is always something to watch for potential dilution down the road. Now, for the scary part, the risk factors section is massive. They are worried about geopolitical conditions, trade barriers, intense competition, difficulty forecasting shipments, and volatile market conditions. They even mention climate change is a risk. This is standard for many companies, but the sheer volume here suggests a lot of potential problems on the horizon. And get this, a huge chunk of their revenue comes from just a few customers. In 2025, 2 customers made up 69% of their revenue. In 2024, 3 customers accounted for 84%. This is a major red flag, folks. If even one of those key clients leaves or cuts back their business, it could cripple Tianci. They desperately need to diversify their customer base. They also have a history of tax problems. They have paid penalties for late filings totaling over $47,000. While they say they have settled these issues, paying on time in the future is key. And here is a critical risk they face. They might not be able to meet Nasdaq's ongoing listing requirements. This is a serious threat that could lead to their stock being delisted, putting investors in a tough spot. Ownership-wise, Shufang Gao, the CEO, is the big dog here. He effectively controls over 57% of the company through his stake in RQS Capital and direct ownership. This means he has a lot of power over the company's direction, which can be good if he has a solid strategy, but also means minority shareholders have very little say. The auditors Bush Sifty Associates CPA LLC signed off on the financials, but it is worth noting the company does have material weaknesses in its internal controls. Specifically, they identify inadequate segregation of duties and a lack of formal policies for reviewing significant accounting transactions. This is not ideal and means there is a higher chance of errors or even fraud slipping through. So what is my take on Tianci? I International Incorporated. This is a company trying to pivot and grow rapidly in a competitive space. The logistics sector is tough and they are spending a lot of money to expand and go public. However, the sharp drop in gross profit margins is a major concern. They are making less money on each sale and their operating expenses have skyrocketed. While the IPO brought in much needed cash, it also brought a lot of scrutiny and new expenses. The heavy reliance on a few customers is a significant risk. The company's future hinges on turning around those shrinking margins and diversifying its client base before it burns through its cash. It is a high-risk, high-reward situation with a lot of hurdles still to overcome. Alright, that is our deep dive into Tianci, I International's latest filing. What do you think about their strategy and those nose-diving profit margins? Let me know your thoughts in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe for more corporate breakdowns. Oh, and don't forget to join our Discord community. The link is in the description for more exclusive content and discussions. Thanks for watching, and we will see you in the next one.